Hello traders, it's Saturday, May the 4th. This is John Kicklighter, Chief Strategist for DailyFX.com, here to give you your FX market wrap-up for this past trading week and an outlook for what we can expect in the week ahead. Of course, the event risk this past week was exceptional, and the volatility that resulted from it was also exceptional. However, we still are lacking for that commonality factor. Now, some people would call me on this and say that that is crazy because we had a strong risk positive push. That's absolutely true. We did have a lot of these risk sensitive assets pushing higher, and I do not doubt that because it was pretty evenly spaced when you look at something like equities and commodities and carry trade. But we're going to talk about some of the fundamental problems with a risk positive move and why it's not an optimal trend based trade, much less momentum trade. All right, so with that in mind, however, I think that we have to start off our video with a strong reflection on this incredible move. The S&P 500, my benchmark for sentiment-based trends. Remember, it's not just a risk reflection. In fact, its deviation from risk itself is something to be concerned about, but it reflects sentiment. But more importantly, getting away from the fundamentals of sentiment, it looks at the confidence and positioning and yield chase that occurs with the association to stimulus. Okay, and with the deviation between the S&P 500 and what the market can reasonably be expected to return. This is actually the S&P 500 versus market yield, an aggregate of 10-year government bond yields from the majors, which is not necessarily the full rate of return you're going to get, but it's a baseline. It's a benchmark for what you can expect. And as you can see, quite a significant deviation. However, this difference is filled in nicely by expectations of stimulus, and that stimulus works to encourage people to take on greater levels of risk because the assumption of a move adverse to their position declines, volatility declines. So there's no need to actually have something on the sidelines protecting your position, taking out that insurance, because you can put it all into your position. You can put it all in to chase whatever assets you can because the yield is so extremely low. And we can see the negative influences this has. We've talked about this before, but the level of participation has dropped off substantially, something measured in the aggregate open interest for S&P 500 futures. A lot of people say that the capital is shifting away from the S&P 500 futures and to other assets, and that's absolutely true. But it generally shows you that the traditional assets, the most liquid, the biggest, and the S&P 500 futures is a good measure of hedge and outright speculation. When that diminishes, you know that there is an exceptional pull out of capital from those bigger, deeper assets. And you can see the heady level of risk that's in the market. This is the measure of leverage behind equities. This is the difference between margin debt and cash balances with New York Stock Exchange brokers. So the difference is the level of leverage that that investors are using, and as you can see, an extreme high. Nevertheless, these are medium-term concerns, and this is why I'm not so enthusiastic about a bull run. Otherwise, I would, but I just cannot. Even if we had relatively low growth and we were able to actually live with those low growth trends because we have reasonable rates of return or a attractive entry or attractive pricing, I wouldn't necessarily be concerned about the growth as much. I'd be willing to go for it. You roll with what the market's showing you, but I cannot roll with a market that is showing me such extreme complacency and lack of regard for such dangerous fundamental conditions. Nevertheless, big move, probably the biggest move through this past week was the S&P 500's rally through 1600 and the Dow's impressive move just short of the 15,000 mark, both record highs. All right. And that improvement, that big risk-based move, as I said, was generally a market-wide phenomenon. You saw a rally from the 10-year government bond yield. You had the CRY index, or the Reuters Jefferies Commodity Index, CRB, sorry. The S&P 500, of course, the dollar yen as a carry trade reflection, up. And you had risk-reward index up. Now, personally, I have a concern about the positive implications of restraints, as I just laid out for you generally. But I can see some opportunities if a big move along the lines of what we saw with the Dow or the S&P 500, you see that you cleared a significant level and there was some very strong follow through. That was an impressive move. That level of conviction, that level of follow through is not necessarily a fundamental reflection. It's more of a market mechanic move. Knowing that 1600 was a major level, for example, there's no doubt a lot of entry orders that were placed just above 1600, which were filled on Friday's move, and shorts that were on before the event risk that we had, non-farm payables, we'll talk about that in a second, but shorts that were on with a stop above 1600. With that big move, you have a strong push of follow through because you trip so many orders, whether it be entry or stop. The exact same conditions that we talked about when we had that major break below 1525 and then 1500 for gold. All right, same exact conditions. Now, if there is a little bit of follow through, and I'm not doubting that there could be follow through, especially considering that it has a market-wide sensibility to it. If you do find a couple more steps for follow through, I think that there's some actually prominent opportunities. Now, it all depends, however, which trade I like on the actual pace of conviction. The lowest hanging fruit that was out there, and one that the only risk positive trade that I took into the end of this week, I had a lot of entry, or I had a lot of setups that I was actually looking for short risk. The only long risk trade that I had and that I was knocked in on was the Aussie yen. As I was talking about through the close of Thursday's session into Friday morning, this was a tight congestion pattern that necessitated a breakout. All right, it necessitated a breakout. It had to. It was a terminal wedge, meaning it would put in for a break regardless of what happened because it just runs out of room. Now, this did put in for a remarkable move to the upside. I actually got in just around 101, and since it had that impressive move to the upside with covering 100 pips very quickly, I decided to take the first half off at 100 pips, or actually 110, and then I trailed to stop to break even on the remaining half. So this is pretty much open to find follow through when the markets open up Sunday evening, Monday morning, depending on where you are, and I'll be happy if it continues. But if it goes back, that's fine because I have minimized my exposure to this risk. Now, this one has already made its move, but many of the other yen-based crosses, and a couple in particular, look particularly good for potential follow-through beyond this level. Now, remember, this requires a greater level of follow-through, and there is sometimes some differential momentum when you're talking about equities versus the carry trade, which is the FX version of risk trends, or commodities, or whatever it happens to be. So if we do have follow through on risk trends that spills over to the carry trade, particularly, I'm going to be looking at a couple pairs, but my first inclination for a new move, a new break, will be dollar yen. I've had my entry order, and it's an open entry order at about 120. All right, so as I've described before, this is the midpoint of the past 10 years worth of price action, the range over that period. So if we can break that level, that would be a significant milestone. And just like the S&P 500 crossing 1600 and gold dropping below 1525 and 1500, you have to expect that there is a significant round of entry orders and stop orders. Options actually show a significant nest of interest around here. However, the general lack of open interest in options skews these numbers nowadays, so I can't even use that as a viable measure. But there's a very good chance that there is nevertheless orders up there. So I will keep that entry order through the weekend, and I'll see how the first 24, 48 hours of price action develops. I don't like to just keep entry orders open and to do what they will. I like to only put them on when I know I'm not going to be able to monitor my trades, and I have a high confidence level that you might actually find follow through, not just the break that actually gets to the technical level, but the follow through that actually makes it profitable. So my strategy with this, and I actually had a couple of people ask me this on the real-time news feed, what would you do in terms of the break? Where's the stop? The stop, first of all, has to be pretty wide. You have to be very liberal with the stop. So my stop is actually over 120 pips, and that is to allow for a volatile move that has a little bit of shake and then allows for follow through. However, with a significant level of orders around that level, if that is indeed the case, then it's very likely that you do just have immediate follow through, much like gold and much like the S&P 500. They made their break and they did find quick follow through. There wasn't much questioning and chop before the continuation. And that's generally what the case is when you have a large level of entry and stop orders. So I expect that to be the case, and if the 125 pips is covered, then it wasn't meant to be the trade that I want, because the trade that I want requires the immediate follow momentum. Now, the additional factor is that even if I'm not watching the trade itself, you need to be able to have some level of trailing the stop. All right. One of my favorite conditions in terms of trading is to be able to take profit on the first half at essentially when the market moves equivalent to my risk. So if my stop is 125 pips, my first target will be 125 pips. So I'll set a short entry on half the order, or half the order size at 125 pips higher, and then subsequently I also have a trailing element on my stop. So once the position is entered, I have an automated stop that goes with it, and I also have a trail up on that stop. So once it hits 125 pips, not only will I take half the trade for profit, but the second half finds its stop trailed up. All right? It's important that if this is the development that could potentially happen, that I have this all as a self-contained strategy. These are generally the steps I take when I'm watching the trade, but this is what you need to do if you're going to set an entry order and you're playing something like this. But this is my second lowest hanging fruit on a risk positive move. Why? Because there's given the high level of complacency, which I definitely think that there is a high level of complacency, a break above 100 would be relatively easy, and the follow through would be probably quite significant. You could see a similar situation on some of the other yen-based crosses. The pound yen, as you can see here at this 38.2 fib, would be it's already cleared its high. Now, if you break above that 38.2, it would probably be a significant follow through as well. And I do think that generally the pound has more room to advance than most other majors. Now, I'm not as inclined to look to the Kiwi yen or the CAD yen. I know they have the higher carries. These are in the investment currencies of the carry trade world, or the yen-based carry trade world at the very least. But my concern is that I already have the Aussie yen, and I'm not actually looking to trade for a committed risk appetite trend. My advantage in trading something like the dollar yen is the fact that I think that there is a heavy shift that can be made if we break above 100. There would be a substantial mechanic that just steps in and adds to that momentum. I don't have to depend on the fundamentals, which I do not believe in, for a long carry trade or risk-on trade. Now, other opportunities are out there, and they are a little bit higher up. They require a little bit more conviction in terms of risk appetite. I'm watching the pound dollar. We've talked about this one before, and I traded this one a couple times. Once it got out of break even. The second time I managed to take over 100 pips on it. This time I'm going to see if there's a follow-through conviction to break this midpoint of so far this year's range. If you can break above that 55.75 level and clear it, right, a lot of people think that it's just a tick above the level and then you jump in. That's not how you should trade this. It needs to be a clear break, preferably a close. I don't need to go for the daily charts necessarily, but it's more along the lines of a 8 or 4 hour body close. So if we see a break to the upside, that has some potential, but this too is slowing down, and it's not as sensitive to risk appetite trends. So the level of interest is materially lower. Aussie dollar is another one that has some follow-through potential as it trades back within this much larger range. However, the conditions to fulfill a move to the upside are a little bit more troublesome. This one has shown some substantial chop, so I'd really have to see some positive levels of risk. Now, there are a couple other general currency pairs that get into the more arcane. The Kiwi Swiss, I actually was able to take advantage of the move to the downside. I should have taken advantage of the move back to the upside playing this reversal. However, I did not. It's just a lapse of judgment. You should always treat each trade, even after you get out of a pair, as a new trade opportunity and evaluate afresh. But you can see that this has a nice push through. Follow through to the upside, however, is going to be a little bit difficult just to continue at will above 80.50 because there is probably going to be some significant resistance. This has been prone to congestion with time. Pound yen has a lower threshold boundary reversal, but it's going to be questionable. Now you'll notice that I didn't go for any of the euro-based pairs. The euro itself is going to be a questionable one. Into the end of this past week, we had two particularly interesting fundamental developments. This is the Manic Crisis Calendar, which I curate. Both of these developments, so you can see on the regular dailyfx.com calendar. The EU spring economic forecasts, the Eurozone region was actually downgraded for its growth forecast from 0.3% this year to 0.4%. All right, that's a significant contraction for the entire region and does spell some very significant problems. And it negates somewhat the easing that was given by the ECB. Now, the ECB's moves were interesting because they were not balance sheet adjustments. So they weren't necessarily going for a currency war fight, which is one of the big reasons that you have currencies like the Japanese yen so substantially lower, because they are participating in the currency war. Well, that move, the moves that the ECB made, were not aimed at increasing the balance sheet. They kept them the same. They do, however, speak to a certain level of uncertainty and to some degree desperation. But this is going to probably be a lackluster influence. This is not going to have the necessary influence, especially when we're talking about such a dour economic outlook. All right, we have a lot of commentary this coming week that is going to be related to the Eurozone monetary policy. There's going to be a lot of speakers that are speaking, particularly on this. There are a couple very, very prominent meetings that you should also be concerned about, like the discussion with the Troika on the Cyprus bailout. And of course, when we get into Friday and Saturday, we have the G7 meetings. Those are going to be all notable for the Eurozone. But generally, I'm willing to bend on risk trends and go long risk appetite, even though I don't necessarily believe in it, because you go with where the market's going. You ride the wave. But if there's too many hurdles to, or if you say too many rocks in the surf, this is not something you want to do. And that's exactly how I feel when it comes to the euro. All right. So when I look at the euro dollar and I see the potential, maybe bouncing off this trend line, it wasn't a trade that I was particularly interested in. I still think that this has potential to break to the downside. It's not my favorite euro trade. If there is a move towards risk aversion, I think that the better risk-based trade that has the euro involved is going to be the euro yen. All right. You can see here that we have a nice congestion pattern. Of course, if risk appetite does continue higher and the dollar yen makes its break, the euro yen's probably going to follow along. However, if risk completely flatlines on the open and even pulls back, the euro yen's going to be one that can pull back off this range, potentially get a break to the downside. I'm going to be watching 127. I think 127 or 126.50 break would be very interesting. Of course, it has to come alongside risk trends, but when you're looking for risk aversion, you want to look for the most troubled currency and the most appealing currency. In my book, the euro is the most troubled currency. All right, it's been given too many passes, and the market is too blasé about its troubles. The yen, on the other hand, is the most oversold currency. All right, so it has the greatest potential net for seeing a reversal in sentiment, but the market has to be on the same page as me. All right, it's not something I'm just going to trade. I have to see the market confirm it. If I want to get away from risk trends, then I like the euro pound. As I talked about with the pound yen, I think the pound has a lot of room to move, and it's one of the currencies, probably the currency or the major that has the most room to run. So I'm going to be watching this euro pound move. I've been talking about this one for some time. You can see the technical interest here. You have this trend line, which you can call very ugly head and shoulders pattern. I won't go that far. This is a nice 38.2 fib at the 84 level. Also a trend line that we've just kind of hovered around for a while. It has good interest, it has good appeal, and fundamentally I like it. Now the euro has to be troubled enough, but if the euro pound is breaking 84, there's a high probability that the fundamentals are the factor doing the pushing. Not risk trends that can be somewhat volatile, but more about either the pound showing genuine interest or the euro seeing genuine weakness. Now, the euro is going to be a big opportunity. Risk trends are going to be a big opportunity going forward. And the yen crosses, of course, I think have some of the greatest potential because they are sensitive to the risk factors. And when I pair up risk on or risk off, there is a lot of yen crosses that come to this grouping. But there's also the interest when you're talking about risk-based trends or you're talking about the US dollar. All right, dollar index, as you can see here, still within that congestion pattern, was able to save itself despite the fact that you had the Fed not cutting QE3. But this QE3 argument is going to be substantial going forward. I know that a lot of people were disappointed by the Fed's rate decision this past week in which they did not change monetary policy, and they were disappointed because there wasn't that short-term impact or that short-term reaction. That's fine. We should not expect that from the Fed. They're going to move slowly. They're going to move deliberately. But my greater interest was in the non-farm payrolls report with the Fed rate decision. Now that potentially confused a lot of people. When we saw the increase in non-farm payrolls, a better than expected figure, you had 165,000 jobs added to the economy through the month of April. There was an argument that there was a drop in the actual average earnings, which, yes, fundamentally speaking, that is important, but realistically speaking, that's not what the markets are looking at. I only want to look at fundamentals from the perspective of how the general market's going to look at them, because that's how they're going to trade. And if they're going to trade that way, that's the way the market's moving. So we did have this positive outcome. Furthermore, you actually had a downtick in the unemployment rate, so 7.6% down to 7.5. Now we talked about this yesterday. With a downtick in the unemployment rate, you get closer to the period or the tipping point where the Fed says, all right, we no longer need QE3. We need to stop taking such an expansive base with our monetary policy regime. All right, 6.5 is the percentage that we hear kind of floated so often. Yes, 6.5% is when they're going to turn from a dovish regime to a hawkish regime. In other words, they're going to, instead of expanding stimulus, they're going to actually take stimulus out of the market. However, easing back on QE and even stopping QE is not a hawkish move. You are not actually tightening your policy. Well, technically you will if you actually slow it enough, but we won't get into the technicals. All right, this is a marginal effort. They've talked about a greater potential of flexibility and changing their QE purchases going forward. They said both increasing and decreasing in their statement. Now I'm going to say to project that probably means that they're just warming us up. They're getting us ready for that eventual change, and their change is going to be small on the first move, but then they're going to gauge the market's reaction and then try to move steadily from there. It is very likely that if you're going to have this test move and you want to avoid excessive stimulus because of the X risks, which that's something that Richmond Fed President Lacker was talking about this past session Friday, they're going to have to start doing this relatively soon. All right. Lo and behold, we also have June, the next rate decision, in which they are talking, that's where they're going to release their growth forecasts, their inflation forecasts, and interest rate forecasts. That's the perfect opportunity. That and Bernanke's press conference. Perfect opportunity to actually make a change and explain yourself. All right. So we'll keep that in mind. We'll see if the market actually considers that. But why did the market not react with the expectation that QE3 could potentially see a pullback with a lower unemployment rate? All right. Well, because they just came off the Fed and the Fed didn't say anything. So they took that alongside the positive growth implications, and that was seen as a positive for risk. But at the same time, it wasn't too much of a negative for the US dollar either. All right, this is going to be interesting. I don't think that if this is a risk trade based on the employment figures, it's probably not going to last. The only reason that this is going to find follow through in the immediate future is because you broke a key level, and there might be some follow through just as traders start to, or the average mom and pop investor starts reading over the weekend that the S&P 500 broke 1600 to a record high, and the Dow Jones Industrial Average broke to just short of 15,000 to a record high, and that's going to draw a little bit more of the sideline interest that they always like to talk about. However, it's probably not going to last for very long, because you have to remember, got to go back to the underlying fundamentals, and when we see the underlying fundamentals, we are still exceptionally divergent from current price and the fundamentals of risk reward. All right, the yield potential is completely absent, and this absence of return is forcing people essentially to take on exceptional and unnecessary, well, I guess necessary because you have to chase whatever yield you can get, but exceptional leveraged and extremely risky investments, which it has a very good chance of ending very messily for many traders, similar to how we've seen massive pullbacks in the past. All right, that peak that we had in the dot-com bubble, the peak that we had before the financial crisis. Not saying this is an immediate turning point, but you set up the building blocks for this. And I made this chart just as a reference. The S&P 500 and retracements, meaningful retracements that we've had from the high. And you can see that recently we've had a 9-point-something% pullback, and I believe this is a 7% pullback, but we haven't had a 10% pullback in 576 days. That includes weekends. We haven't had a 15% retracement in the same amount of period, or same period of time. And we haven't had a 20% retracement in 1,516 days. That's 4 years and change. That is a long time without a meaningful correction. So you got to remember, a lot of people have leveraged up their position, and unless you're going to get a significant increase in participation, risk trends can only go so far without new money coming in, and the fundamentals are so divergent. So I'm not necessarily interested in playing a strong risk positive position. So that's why you don't see me talking about euro dollar to 137.50 or dollar yen breaking to 120 in the next couple of months, or Aussie dollar finally taking out 106. Those are factors that I do not think are reasonable, all right, because of the fundamental conditions. But there are opportunities for short-term risk positive trades, not necessarily because of risk, but because of how the market conditions are formed. All right. The last thing I want to leave you off on this weekend is a quick look at the commodity world, because we had some pretty incredible movement here. Oil is a particularly big player. You had two big aggressive moves. Thursday's rally was the biggest rally in 6 months, following the biggest drop in approximately 3. This is a big wedge, so as we come closer to this 97.50 level, watch out, because that's going to be a strong collection of resistance. I know a lot of people are also watching gold, as they should, after that massive record-breaking decline below 1500, 1525. A lot of people are wondering, are we going to get back above there and eventually make our way back up to 1800, then 1900's peak high, and then on to records? Well, I don't think that that is going to be the case unless you see a complete devolving, de-evolution of the financial situation across the globe. If you have a breakdown in the FX markets where they become exceptionally volatile and people don't know how their assets are being valued, then people move back into gold. In the meantime, if you take a look at some of the positioning considerations, so I took up the COT figures, the positioning for futures traders, and you can see that we are the lowest since December of 2008. All right, not a good sign for bulls. We also have a consideration of the weekly charts, where the week-over-week changes. Yes, you had an advance, but that was after two aggressive declines, the two biggest back-to-back declines we've had since 2008, percentage-wise. But we also have ETF outflow, which is incredible. I know I hear a lot of this central bank or that central bank bought a couple thousand ounces of gold, or there's demand in Asia because of the holidays. Those factors are there, but that kind of demand is not offsetting these bigger outflows. All right. So a lot of interest going forward, a lot of activity. All right. The docket that we have going forward is not as dense as we've had it here. We have a couple highlights like the RBA rate decision, the BOE rate decision, the Australian employment figures, Canadian employment figures. Those aren't big ticket items. The G7 is probably the biggest ticket item that we have. The Cyprus discussion is probably another one. But these aren't the kind of conditions that we will be looking for major trend development. But that's the perfect time for it to actually occur. We don't have these big distractions that's ahead. You can actually just see the market develop as it does with risk-based considerations at play. So be very cautious, be very aware, but be flexible. I'm looking to potentially go long a couple risk-positive trades, but it's not because of risk, and I don't believe in risk. But you have to be flexible in these conditions and be willing to trade what's in front of you. I hope you all have a great weekend, and I'll give you a wrap-up for next week, starting on Tuesday, as I will be out. Until then, I'll talk to you guys on Tuesday.